Hey everyone, you're listening to the Ask BP podcast, and today we're talking about cap rates, what they are, how to calculate them, and how to use them as real estate investors. Stay tuned.
You're listening to another BiggerPockets Ask BP podcast, where you'll hear short, direct answers to your biggest real estate questions. Submit your question today on Facebook, Twitter, or the BiggerPockets forums by using hashtag AskBP. And don't forget to pick up your copy of the Ultimate Beginner's Guide to Real Estate Investing and other great content when you sign up for your free account at BiggerPockets.com. With that, let's get to the show.
All right, today's question comes from Tish from New York City, New York. And she asks, very simply, what is a cap rate? Well, Tish, from the broad generality of this question, I'm going to assume that you are relatively new to the world of real estate finance. That's totally okay, and I'm going to try to break this down into manageable chunks that are digestible to both you and any other new listeners that don't really understand the concept of cap rates and how they're applied to commercial real estate. So we'll start from the beginning. What is a cap rate? A cap rate is simply a mathematical measurement of how much income a property produces relative to the purchase price. So that means you need two pieces of information, right? You need a income and you need the price. Well, the income is actually a very special type of income called net operating income. And what that income means is that this is the amount of gross rent that the property collects, subtracted by any vacancies and operating costs. We'll get into exactly what operating costs are versus other types of expenses like capital expenditures and financing costs down the line. But for now, just realize that cap rate is a function of that net operating income and the purchase price, how much money the property generates relative to the price you pay. Now, have you ever noticed how properties in different parts of the country, single-family homes for example, vary very dramatically in price for the same type of structure? For example, a single-family home in San Francisco might be close to $1 million, while the same structure might be only $100,000 or $150,000 out in the Midwest. Well, that's because people are willing to pay a premium for the same types of property in different parts of the country. They're expecting those other areas of the country, perhaps San Francisco, to appreciate in value. Well, that same line of thinking can be applied to cap rates, right? Let's say that we had a property in San Francisco that was priced at $2.5 million and produced $100,000 of income. Well, that $100,000 is 4% of the purchase price of $2.5 million. That means the cap rate on that property is 4%. Now, the same structure out in the Midwest might have a cap rate of 10%. That would mean that the $100,000 is 10% of the purchase price for that property. Therefore, the cap rate is 10%. So this brings us to the question as investors. Why on earth would anyone in their right mind want to purchase a property with a lower cap rate? A property that produces less income per dollar invested, right? Why would I want to pay $2.5 million for $100,000 in income when I could pay $1 million for $100,000 in income? It seems like a no-brainer to me. Well, there's a couple of reasons for this. The first is potential. Investors, or at least the market, values property in certain locations higher than others because of possible income production in the future. You know, perhaps in San Francisco, the rents that the building are going to produce are going to rise faster than they are out in a property in the Midwest. The second component is this concept of leverage, which is a little bit more abstract. So in that property that we're talking about that produces $100,000 of income, let's say that I come in and I'm a good manager for the property and I cut the expenses of that property by 10 grand per year. Well, now the income that the property produces is $110,000 per year instead of $100,000. At a 4% cap rate, I've produced $250,000 in value. That means the property goes from $2.5 million to $2.75 million. That's a large value creation. Cutting that same expense on a property with in a market with cap rates of only 10%, well, that's going to increase the value of the property by only $100,000. So there's a little bit more opportunity if you can cut costs and capture a lot of value quickly in markets with lower cap rates. Now, all that said, you know, both with the leverage and the potential opportunity, we want to factor in cash flow, and the fact that you're getting more money on your investment in a higher cap rate market is generally a good thing for a lot of cash flow investors. All right, so now that we've talked about kind of what cap rates are and how they can differ in certain ways and why you might be willing to pay for a property with a lower cap rate than a higher one, let's talk about the specifics of calculating cap rate. So the most important concept to understand here is this concept of net operating income. Net operating income is not the same as how much money the property produces. What it tries to do is it tries to say, here's the amount of income this property will generate in the normal course of business. So net operating income does not include things like capital expenditures. We have another video on capital expenditures, so we won't talk about that right here. But the basic concept is, if I have to replace the roof on my property for 200 grand, that's not an operating expense because that roof is going to last me 10 to 30 years. So that's not an operational component of the building I'm buying. Operating costs are things like vacancies. They're things like utilities, maintenance, repairs, property management. Anything that occurs on a regular basis is more of this operating cost. We also exclude from operating costs any financing costs. So a mortgage or loan payment that you have as part of the expenses on your property would not be considered an operating expense, and it would not be part of your net operating income. The reason we use this net operating income again is to get rid of all the extraneous things that are not relevant to the business of the property on a regular basis, so that we can compare properties easily. Now, it's important to understand that financing and capital expenditures and all those things still come into play when you're thinking about purchasing commercial buildings. Obviously, you're going to pay less for a building that needs a new roof right away than one that's just had it replaced last year. But it's important to understand that when we're calculating cap rate, net operating income excludes those observations. Another very important note about net operating income is that there's two things that you're going to be shown whenever you're looking at a property. The first of these things is called a pro forma net operating income. The other is the actual net operating income. Now, I've been in the world of finance for most of my professional career, and while I construct a lot of financial models and project expenses and costs and revenues, pro forma really means my best guess, or just my guess, not even my best one. The broker that's trying to sell you this property, or the seller himself, is going to make up numbers. They might even be very good guesses. But at the end of the day, they're made up guesses, they're made up numbers, they're guesses, they're estimates. You don't want to use the estimate in your calculation of cap rates and net operating income. You want to use the actuals. You want to buy the property on the basis of how it is actually performing, and you can apply your own estimates for how it's going to work in the future. Sometimes the broker may offer, or the seller may offer, only the pro forma at first. It's important to make sure that you ask for the actuals whenever you're looking at any of these commercial or income-producing properties, so you can base your analysis off of the facts rather than the guesses of the future. Okay, so we understand what cap rates are. We understand how the specifics about how to calculate them and calculate net operating income accurately and reasonably. The next part of the discussion is, how do we find what a fair cap rate is for our area, our market, or that specific property? Now, just like with residential real estate, buying and selling homes, this comes down to understanding your market and the conditions surrounding this specific property. Cap rates are going to vary not just market to market, but property to property, even block to block. Just like, a property a few blocks away from another can be worth considerably more because it's on the beach or, facing the park. So just like with residential real estate, you need to go and you need to pull comps and understand, hey, this commercial property that's very similar to the one I'm looking at sold very recently at a 5% cap rate. But this property needs a new roof. So I'm going to factor that in to the cap rate that I'm calculating when I'm buying this property that I'm looking at. And you have to kind of do this with all of the different factors that might come into play. You want to know what's going to affect the next year's income. You want to know what kind of expenses to expect over the next couple of years. And you want to understand the potential of the property and the specific location that it's in. To boil that down into simpler terms and to use in proper finance speak, I'm willing to pay more for, or I'm willing to pay a lower cap rate for a property that's newer, nicer, and in a better location than a property that's older, decrepit, and in a poor location. One of the best places to start in understanding fair cap rates for your local market might simply be to start contacting a few local commercial real estate brokers. Alrighty, everybody, now it's time for our success quote of the day. Today's quote comes from Robert Kiyosaki, and he says, "We were not taught financial literacy in school. It takes a lot of work and time to change your thinking and to become financially literate." Guys, cap rates in commercial real estate are not a hard concept. The math behind them is not very difficult. It comes down to understanding expenses, revenues, and the purchase price of the property. The problem with this is that all of this stuff is buried under a layer of financial terms and financial speak. Once you can speak that language, once you become financially literate, this process becomes very easy. It becomes very simple to value properties and understand exactly how much money they're going to make, exactly how much money they have made, what a fair price is based on what else is going on in your neighborhood, and what other investors have purchased similar properties for. Make yourself financially literate, and you'll reap the rewards for that education throughout the rest of your life and the rest of your investing career. All right, thanks for listening, everybody. I hope you enjoyed today's show, and if you did, please give me a thumbs up if you're watching on YouTube, or just leave a little comment in the section below the video on BiggerPockets. And remember, in pursuit of your dreams, don't just learn, but take action. For the Ask BP podcast, this is Scott Trench, signing off.
You've just heard another episode of the BiggerPockets Ask BP podcast. Submit your question today on Facebook, Twitter, or the BiggerPockets forum by using hashtag AskBP. And for more incredible real estate investing tools and education, including a free download of our book, The Ultimate Beginner's Guide to Real Estate Investing, head over to BiggerPockets.com and sign up for your free account today. We'll see you on the next show.